So today we will do financial ratios. This, if you remember, we have already done sessions 1, 2, 3, 4, 5, 6, 7, 8 we have skipped for the time being, and then we did 9 which was on depreciation, right? And today is the 9th class, but we will do financial ratios, because this is actually session last 3-4 sessions, but I thought it is important to know the basics of ratio analysis at this stage without waiting for the last few classes, and as it is part of your midterm, right? So that is why it is again important. So yeah, so financial analysis is used by everyone, right? Anyone who is dealing with the annual report of a company uses some kind of analysis, because what do you do with a number? You try to make sense out of a number, right? You take decisions based on number, right? So financial analysis is something that is used by anyone who is using the annual report. And if you remember Kakani chapter 1, you will remember they have given a long list of exhibit wherein they have mentioned who uses annual report and for what purpose. There is a list of 20 users and the specific purpose that they use it for. You remember that, right? That is from, I never covered it in the class in such detail, but it is mentioned in the book, and it is assumed that you already have read the book, right? Congratulations. So even if you have not, you have all of tomorrow. बोर हो जाओगे after the Independence Day celebration, आराम से पढ़ना, right? हाँ, बोर तो हो जाओगे, कुछ करने को कुछ नहीं है यहाँ पर. क्या कर रहे हो? अच्छा, इसका मतलब रात को फ्री हो? अच्छा अच्छा, ठीक है, तो ठीक है, शाम को कर लेना, इट्स नॉट ए प्रॉब्लम, राइट? So you don't have to necessarily read it in the morning, you can read it in afternoon, evening, night, right? So you remember the residual concept? Equity is a residual concept, you remember that? वैसे sleep is also a residual concept in MBA, right? So managers use ratios to guide, measure and reward workers, such as criteria for bonuses. You know, at times, if you remember, and you will see it more in the corporate governance class, the incentives of top management of a company are linked to attaining the budgets and the financials of the company. So if Aman and I are the CEO and CFO of a company, our salary is dependent on attaining the target. So if we don't achieve the sales target or the profit targets or the new orders targets, then we will not get our. So about 70% of pay at the top levels is variable pay, and then we have these stock options, which and so So a huge chunk of the salary of CEOs is variable in nature, right? In addition, they also have ESOPs, employee stock options, right? So as a result, they themselves have incentives. Did we talk about agency theory in this class? We have not. You have not heard of agency theory. ठीक है, I won't talk today, maybe बाद में याद दिलाना in the next session, because I spoke about it in the law class in this context only, similar context. But so agency theory, essentially I will just summarize it in 1 minute for you. Agency theory is derived from, or the research work of Burley and Means in 1932, and also Jensen and Meckling. In fact, Jensen and Meckling's work on agency theory got a Nobel Prize in economics, right? So the essence of agency theory is, if we are the, let us say we are the directors and they are the shareholders, right? If there are no restrictions, then we will take actions that benefit us, because every individual will take such actions. Then the shareholders' money may be lost because they are the principal and we are acting on their behalf as agents, right? So the essence was, they need to put some kind of restrictions on us, so that we work for them. So, if they link our own variable pay with achieving the company targets, if they give us a lot of the money in the form of stock options, then our targets are essentially aligned, right? Our targets are essentially aligned, right? Because then we will both work towards the same target. Otherwise, if our pay is totally fixed irrespective of whether the company is in profit or loss, and if we have no stake in the company like stocks on stock options, then हमारे क्या जाता है, then we will take 10 crore salary and we will just enjoy ourselves. Whether the company achieves the target or not is a separate issue. Are you getting what I am saying? So, the principal must act or put some kind of agreements in place which ensure that agents, which are the directors on behalf of the principal or the shareholders, are working towards the same agreements. Yeah? So that there is goal congruence, we are all working for the same targets. So, the reason, so managers use ratios for various purposes as elements in contracts to manage the business by examining year to year changes and the causes thereof. Next. So, the use of ratios typically involve comparisons. One can be, are you as good as yesterday? Okay, let me put it this way. You came here on, say, let us say your classes started on 15th of July, today is 14th of August, 1 month has passed. Have you learned something in accounting, the financial reporting and analysis? अगर anyone feels not yet learned, उसको assignment थोड़े extra दे देते हैं. सबने learn किए है ना? Perfect. So, you compare yourself over time. 1 month back, especially engineers or non-BCom, non-BBA people, right? They had zero knowledge of accounting. Now at least you know something. So, over time you have improved. So, similarly, the first comparison is with self, but over time. That is a time series comparison. Compare the company's ratios with its own ratios over time. So, if you look at yourself 1 month back versus now, that is a comparison over time. The second comparison is a benchmark comparison. So, earlier you would have scored, let us say 0, now you will score, let us say 40, let us say at this stage in accounting. Second is a benchmark comparison. Compare the company's financial ratios with benchmarks. What is the ideal to get in accounting? 100 out of 100. So, the benchmark has to be 100, let us say, yeah. Benchmark can very well be 90 or 80, right. So, we have something called say current ratio, for example. So, current ratio is a measure of current assets divided by current liabilities. So, one is you measure current ratio over time, last year versus this year, that is what this is, right. This is benchmark is the ideal current ratio irrespective of industries. People generally say it should be at least 2, right. So, if the current ratio is to be 2, then the benchmark comparison should be 2. If you are at 1.5, then you should think, yeah, I need to go up, right. The third is a cross sectional comparison, where you are comparing yourself with ratios of other companies, usually in the same industry. So, in your industry, your current ratio is 1.5, in your industry on an average it has been seen for other competitors of yours, it is say 1.8, right. So, in such a case what will happen is, you will compare yourself, last year it was 1.4, this year it is 1.5. So, this is a time series comparison. Here you are comparing, mine is 1.5, but ideal should be 2. So, that is a benchmark comparison, and this is cross sectional is across companies in the same industry, ideally even other industries is also possible. In that case, well, ours is 1.5 and someone else has got 1.8, others have got 1.8. So, again we are low. Are you getting it? So, it is almost like if you had appeared for accounting exam last month, you would have got 0, now you will at least get 40, right. This is the target should be 100, and this is, I got 40, but Chirag got 58. So, I have to rise to his level, or the rest of the class average is 55. So, are you getting what is I am saying? So, this is cross sectional comparison. Next. Okay. So, we can ignore this slide because I have to cover a fair bit of material next. Next. So, when we do financial analysis, we can do it in multiple ways. We can do financial analysis in multiple ways. I will share the slide. So, you do not have to write anything that is already in the slide, but what you must write if you wish is anything that I say in addition to the slide. If while explaining the slide, if I am saying something, if you want it, feel free to write it, but do not write whatever is written here. It is a waste of your time, right? You just observe. So, financial analysis can be done in various ways. One way of analyzing the financials is a horizontal analysis, and this is more like a time series analysis. So, what you will see is, say for example, in 2002 your sales was 1 lakh, 2003 it was 1,25,000 and 2004 1,50,000, right. So, compared to the base year of 2002, in 2003 we see a 25% increase and in 2004 we see a 50% increase. If the base year is changed to 2003, what is the percentage increase in 2004? 20%, right. You have all appeared for CAT here. Do you see that? 125 may you increase by 25, 25 divided by 125, 20%, right. So, that is, but if the base year is taken as 2002, then from 2002 to 2004 we have a 50% increase, right. So, that is the horizontal analysis part of it. Next, the vertical analysis. So, what we did with sales is applicable to all other numbers also. So, we can do horizontal analysis for other numbers also, right. So, now let us turn our focus to vertical analysis. So, vertical analysis is basically taking everything as a percentage of net sales, taking everything as a percentage of net sales. So, this is your profit and loss account. In this profit and loss account, you can do the same for balance sheet also, where total assets will be 100%, and then you can do the same thing for balance sheet also, right. So, if net sales is taken as 100, do you remember we were once talking about sales and also sales return? At times you may get defective products and then they will return the product and then you have to, right. So, you take out the sales returns, so you arrive at the net sales. So, what happened in 2002? In 2002 sales was 80,000, amount returns was 5,000, net sales is 75,000. So, 75,000 the net sales should be taken at 100%, and in 2003 for the same company. So, we can, do you see that you can anyways do the horizontal analysis for each of the numbers? You can anyways do what we just did in the previous slide for all the numbers. So, in 2003 we have net sales of 120 minus this is a typo, minus 6,500 minus 6,500. So, we get 113,500, right. So, this is just a typo, please ignore it. Yeah. So, and then this is net sales. Then when we were doing the profit and loss account, we also spoke about the format. You remember that Excel sheet that I showed in class? So, where we said sales less cost of goods sold, that gives us gross profit. Then we take out selling and administration expenses and other operating expenses. So, we get what? And EBIT, right. And then actually isme nahi hai, but in that sheet you may remember we had then take out depreciation. If you take out without depreciation is EBITDA, then you take out depreciation, then it becomes EBIT, then you take out interest, then it becomes PBT, then you take out tax and it becomes PAT. Do you remember that? Okay, perfect. So, net sales 113,500 minus 65. So, its gross profit is, so what is gross profit? Gross profit is sales minus cost of goods sold. What is gross profit? Broadly sales minus cost of goods sold. So, that is gross profit. And what is this ratio then called? If gross profit is 48,500 and sales is 113,500, what is the gross profit ratio? 48,500 divided by 113,500. Are you getting that? So, which is 42.73, which is effectively saying if net sales is 100, then gross profit is 42.73%. So, this is also showing you the gross profit ratio. You can see that, right? And similarly, what is the net profit ratio? Net profit ratio is in this case, for I am only talking of 2003, you can calculate for 2002 yourself, is net profit, net income or net profit is the same thing, net income or net profit is the same thing, it is 20,500, 20,500 divided by 113,500, 18.06%, right. So, all these numbers that you see in the percentage are actually when you divide this number by the net sales number 113,500. So, this is 20,500 is nothing but 20,500 divided by 113,500. So, that becomes the net income or the, and then that also is called as the net profit ratio, and just try to digest the information. So, all I am saying is the percentage numbers are based on the net sales number this, and again for this is for 2003, same for 2002, this is net sales 75,000, so that is 100%, 80,000 is 106%, gross profit that year is 35,000 which is 46.6%, and net profit is 12,000 which is 16%. So, just digest this number, and then they have taken out selling, general and administration expenses, and so that is the total of total operating. These two are totally the total operating expenses. In this case, it is a very simple example. So, we have not gone into EBITDA, then EBIT, then PBT, then PAT, right. But we have the two final numbers, gross profit and net profit. So, gross net income is same as net profit, right. Everyone clear? Anyone has any questions? So, let us move to the next slide. So, this is a common size analysis, and common size analysis is actually a vertical analysis, but I am having a small business, I am earning 5 lakh rupees net profit in my small business. He is having a big business. So, I have a sales of 10 lakhs on which my net profit is 5 lakhs. He has Aman has a big business, his business is 1 crore, on that he is earning a net profit of 7 lakhs, right. But do you see that in between the two there is a very major difference. The major difference is I am earning 50% profit and he is only earning 7% profit. Are you getting what I am saying? So, when you compare companies of two different sizes, to compare 5 lakh with 7 lakh is not a fair comparison in this case. Or let us, what if I was earning 5 lakh and he was also earning net profit of 5 lakh. So, do you see that when you compare a small fish with a big fish, when you compare apples with oranges, then you have to, absolute numbers may tell a story, but they do not tell the complete story. So, then there you need relative numbers such as percentages, right. So, let us look at a small company versus a big company, and that is the reason it is called as a common size analysis, that what if they were of a common size, then how much would be sales, how much would be gross profit, how much would be net profit, and all other numbers. Let us have a look. It is actually the same slide as the previous one, and all that they have done is this time the numbers are 10 times. This is the same as previous one, 2003 numbers, the small company numbers are same as the previous page, and big company numbers are 10 times the previous slide. So, that is all we have done. So, this we can see 80, all of this is same. So, the percentages are also the same clearly, right. And how do you compare this small company with a big company? So, there we have made the figures 10 times higher than the previous slide. So, it becomes 1.12 lakhs, 65,000, 11.35 lakhs and so on. So, per se it is difficult to compare, but now we can think that okay fine, because you can't compare a profit of 2 lakh 5,000 versus a profit of 12,000, right, it is not comparable. But if you look at ratios, yeah, even he is not doing bad, he is earning 16%, you are earning 18% net profit. Similarly, gross profit, if you look at it, he is earning 46%, you are earning 42%. What if you are a 10 times bigger company, but in the same business? Then you will start wondering, okay, this fellow is small, but how is he managing to keep his cost of goods sold so low? Are you getting what I am saying? We will start wondering, why is our, if we are exactly in the same business, just that he is a small chai wala who is selling chai and samosa, and we are a big shop 10 times or 20 times bigger selling snacks and all. So, you will start wondering here, his cost of goods sold is 53% and my cost of goods sold is 50, because if you are looking only at his cost of goods sold is 40,000 and mine is 6,50,000, you do not understand anything, right. But if you wonder why is his cost of goods sold 53% while mine is 57%, then you are thinking, is there any issue, right. Assuming they are using very similar products, bola, is my purchase manager unethical? Is he unnecessarily buying from market at higher prices? Are you getting what I am saying? So, you have to start wondering, start questioning why your cost is higher by 4%, his is only 53 while mine is 57. So, you have to actually dive deep into those numbers and understand, so that you can take the most appropriate decision for your business. Are you getting? So, now are you getting why we need to do this analysis? Okay. Then if you see that, okay, fine, since his cost of goods sold is 53.3, therefore, his gross profit is 46.7. In our case, our cost of goods sold is 57.3, so our gross profit is 42.7, right. So, our gross profit is lower than him, but yeah, we realize that, okay, fine, even though our cost of goods sold is high, in terms of selling expenses, his was 20%, he has to hire more people, ours one salesman can take care of multiple things, right. So, for us it is lower. Admin expenses are also lower, maybe partly because the bigger the size, then you do not need, right, so many people. If it is a small person, if he still has to hire one waiter to serve tea and samosas to everyone, but for a big shop which is 10 times bigger, we do not need 10 people, we may need only 7 people. So, our administration expenses may be low, because that one person may at times be sitting idle, but you can't help it, but with 7 people, maybe some are sitting idle, some are overworked. Are you getting what I am saying? So, for a bigger business, administrative expenses, as you see, are lower and our net income is actually higher, but our net income is higher, his net income is 16%, ours is 18%, but the reason is our operating expenses are lower, his is 30.6%, ours are 24.6%, but our cost of goods sold is high. So, one, we can be satisfied, we are doing better than him, yeah, he got 16% net profit, I got 18% net profit, so I am doing better. But if you look at cost of goods sold, then you also know that there is still scope for improvement. What is he doing in terms of buying the raw materials and all, the tea and samosa ke liye aloo chahiye, tel chahiye and all those things, he is doing something better which I need to improve on, right. So, you just need to deep dive into those reasons. So, that is the point of financial analysis. So, the overall point is common size analysis helps to compare business across different sizes, and when you put them in percentages, then you can actually dive deep into those numbers and try to understand more. Yeah. Next. So, yeah, let us look at some of the most important ratios. So, it is actually coming up in future slides, but when we look at ratios, they may either come straight from the balance sheet or from profit and loss account or from cash flow statement, or it can be a mix of various things, right. That one number you have to pick up from profit and loss account, another from balance sheet, another from cash flow statement, right. So, day 1, did anyone give loan to anyone else? किसने किसको लोन दिया था? कौन भागा? भाग गया? He has left. See, I was always telling him, be careful, right? He said, अच्छा डियोन से लोन लिया था. Think of it. How much money have you lost? 1 lakh rupees. See, that is the problem. So, when you give loan, that is what we said, na? You have to be worried about return of principal and interest, and return of principal is even more important than interest. Interest तो 7-8% जाएगा, पैसा लेके भाग गया. Okay. See, so you should be very careful, right? So, that was for when you give loan. When you operate a business, you need something called as वर्किंग कैपिटल. जेब में एक भी पैसा नहीं है, कुछ भी खरीदने के लिए पैसा तो चाहिए. In order to do anything in life, you need some money, even though you may be able to recover that money. So even if you want to sell this mic, first you have to buy the mic and then sell it, right? So in order to buy, you need something, right? So that is requirement is called as essentially. So what is working capital? By definition, it's very simple. Current assets minus current liabilities is your working capital. What are your current assets? Cash, bank, debtors, marketable securities, inventories, prepaid expenses. These are your current assets. What are your current liabilities? Essentially any short term loan, trade payables, which can also be called as accounts payable. हम लोग mix, we will use the mixed term. Trade payables, accounts payable, right? Short term notes payable, etc., etc., etc. So current ratio. What are current liabilities? Monies that you have to pay to people within 12 months. Current assets are assets that can be converted into cash within 12 months or operating cycle of the business, right? You remember that we have discussed operating cycle once, na? We have discussed it once, right? So you have, let us say the only current asset you have is cash, let us say 100 rupees, and let us say I owe to Aman how much? 120 rupees. So my current liability is 120 rupees, and I only have, the only current asset I have is 100 rupees. Do I have enough money to pay my current liabilities, right? So the absolute minimum, I am not saying it's ideal, the absolute minimum, absolute and minimum both words ekdam bold, italics, underlined, has to be minimum 120 rupees, absolute minimum in order to pay. Ideally it should be more. What if, because cash is okay, what if my money, I have current assets, but my money is stuck with Chirag. So once Chirag gives me, he is my accounts receivable or debtors. Once Chirag gives me my money, then I will be able to pay Aman. But I have to pay Aman tomorrow, and he is planning to give me after 2 months. And Dion, तुम्हारे तो पैसे आने ही नहीं है, right? Right? So even though I have current asset, can I still service my current liabilities? Are you getting that? So even though the absolute minimum should have been 100, so the ideal ratio, it is said if it is double, then some may get converted into cash later, some may get converted into cash sooner. So overall, even if there is a 50% of the assets are stuck and not readily convertible into cash, even then with the balance 50% I can service my current liabilities. So that's the reason it's, if I have 2 of current assets and 1 of current liability, even if there is a 50% of my current assets are stuck and are not readily convertible, they should anyways be convertible into cash within the operating cycle of the business, which may be say 6 months or within 1 year. So then they are classified as current asset. So even if some part of it, half of it is stuck, I am still able to service my current liabilities. Are you getting what I said? So that's the reason it's said that the ideal ratio should be 2, but that is the very benchmark kind of a number. It always depends on industry to industry. So please remember this thing, current ratio always depends on industry to industry. In some industries it can be high, in some industries it can be low, but it is okay. It's the current ratio of your own industry which is more important if you want to do a comparison, but a benchmark is always good. So that benchmark is 2, right? So it measures the short term debt paying ability. Since some of my, so my money, my current assets are also stuck in, some part of it is stuck in inventory, but he is saying give me my money within next 3 days. He is telling me give me my money in next 3 days. Inventory, first I have to sell the inventory. Let us say I am selling it on credit. Then I have to collect the monies. Can I pay him within 3 days? Right? So those current assets which are readily convertible into cash, which are readily convertible into cash are called as quick assets, and that ratio is called as acid test ratio or quick ratio or liquid ratio. So, cash plus marketable securities, it includes cash plus marketable securities plus receivables on the top. Cash means all, when we say cash, we always say cash and bank, right? But note two things. Inventories is not included. Note, have you noted? Inventories is not included. Prepaid expenses are not included. I have paid rent to my landlord in advance for 3 months, 6,000. You remember that? That is a prepaid rent after 1 month is 4,000. It is a current asset. But will I get that rent immediately if I ask him only, ये तो मेरे को चाहिए भैया. I had told you on day one. I told you on day one you have to pay rent on a quarterly basis. Do you remember that example? So, prepaid rent, even though it is a current asset, I can't convert it into cash readily. So, if he is saying कि पैसे दो मेरे, that money is stuck. Inventory is also stuck. So, that is the reason they are not counted in. So, cash you can pay immediately. I have cash or bank, I can pay it immediately. If I have marketable securities are, I had bought shares of, let us say, Infosys or Reliance. If I need money urgently, I will just sell my shares of Infosys and Reliance in the stock market today, pay him within 2 days. When the money comes, I will pay to him within 2 days, right. So, marketable securities are okay, and receivables, you can count on receivables ki theek hai, it is believed that there will be a steady flow of money, gradually. So, your receivables will keep coming, for one, if you are a small person, you only have one person who will pay you, then you have to wait for that person. But for a big business, there is a steady flow of money. Usually we need how much? We may have 45 days credit, usually 60 days credit. So, the usual business credit period is 30 to 60 days, right, and then you have to pay, right. So, the receivables are expected to be converted into cash usually within 30 to 60 days. Some may be stuck, some may pay earlier also if you give some cash discount, right, that I am giving you a discount, please pay earlier. You remember the cash discount thing. So, this part we have not yet done today, and this we are explaining later in the day, it is coming up in the later slides. So, is the liquidity ratio part clear, fully clear to everyone? Everyone clear on the liquidity? So, liquidity means जेब में पैसे हैं कि नहीं. Liquidity means, do you have enough cash, right? Because if I have to pay whether my short term liabilities, that is current liabilities, or if I had borrowed from bank. So, I had borrowed from you, Khushi, you are the banker. I had borrowed how much? 1 lakh rupees. ठीक है? So, I have to pay to the bank 1 lakh rupees. So, whether, but that is a long term loan. Bank loan is a long term loan. I have to repay it not in 12 months, but 2, 3, 4, 5, 6, 7, 10 years, whatever, right. So, in her case, we will measure my long term solvency, whether I have enough assets to pay my liabilities, the long term liabilities. But for him, what is important is, do you have short term money? बोला बाद में 5 साल बाद पैसे दोगे, मेरे को क्या करना है, मैं तो छोड़ के जा रहा हूँ, I am leaving this place. You will pay me after 5 years, what do? I need my money in 3 days time. So, for him, short term solvency is important, and short term solvency is measured by current assets. But for her, okay fine, she says, okay, you don't have enough cash, I know that, that's the reason I gave you the loan in the first place, right. But I see it's a very profitable business, and in the long run you will do well, right. That's the reason you gave the loan. You wanted your principal and you wanted your interest. So, and you see that there is business potential, so you gave the loan, and so you will be interested in long term solvency, while the first two ratios here measure the short term solvency. Even receivables turnover, inventory turnover, as we will see in the later slides that are coming up, also measure short term solvency, and this I am not talking because we have not done cash flow statement till now. Cash flow statement is after midterm, right. So, yeah, next. So, in terms of I will again not talk about most of them, but in terms of profitability ratios, let us focus at least on two major ratios. The gross profit ratio that I have already explained, gross profit by sales. Alternatively, it is sales minus cost of, what is gross profit? Sales minus cost of goods sold. And the second is the net profit ratio or the net income ratio, which is profit, also called as profit margin, net income by net sales, right. So, these we will see later, but in today's class we will not have time to cover all of these. So, because anyways I will now start diving deeper into each of these ratios, ek ratios we will catch hold of, try to understand what it means, right. Next. So, this is just a listing of all the important ratios, and then we will, this is important. So, just as we had the short term solvency, another ratio is very important which measures the long term solvency, that is called as the debt to total assets ratio. Look at number 1, 2 and 3 we will worry about later. Debt to total assets, and look at the numerator, total debt to total assets. What are the other variations of this? This you can already see. So, I am just talking about other variations of this. One can be debt to equity ratio, and that is debt, total debt by equity, right. And debt, you know, some people, this debt, some people take long term debt, LT long term, some people take total, but in your exam if any question comes, it will specifically say whether it is a total or long term, right. So, debt to equity ratio will be long term debt to equity, it can be debt to assets ratio also, in which case debt to assets. It can be debt upon assets, debt, and debt can, as I said, debt can be either long term debt. So, if the question, if any, asks specifically long term debt, then you have to take long term debt. If it says debt, then you can take total debt, right. So, here you will take either long term debt or total debt. So, these are also solvency ratios only. There in the first instance we were measuring, when I was dealing with Aman, we were measuring the short term solvency of the business, right. When I was dealing with Aman, we were measuring the short term solvency. Does business have enough cash or readily convertible or assets which can readily be convertible into cash to repay the short term obligations, which are the current liabilities, that is the short term obligation. But when I am dealing with Khushi, who is a banker, then we have to measure this solvency only. We are measuring whether I am solvent. You remember what is the meaning of solvent? Who is an insolvent? In Hindi we call it Diwaliya. Do you know that? Diwaliya as in पैसे ही नहीं है, क्या होगा? हाँ, दिवालिया निकल गया, राइट. किसका? कंगला. हाँ, that's a rough term. Diwaliya is a better term, let's put it this way. So when do you see that solvency can be of two types? Short term solvency, I may have in the long run enough money to pay my banker, but in the short term I do not have money to pay him. So, I may be solvent in the long term, but in the short term I am not solvent, and I need both. I need both short term solvency and long term solvency. And so, what is this measuring? This is measuring the solvency ratios only. It measures the percentage of total assets provided, right, total debt upon total assets. And what are two variations of these ratios? One is a debt to asset, but under that we will long term debt to total assets, and then we have a debt to equity ratio, which is debt by equity, and debt can be both long term debt and total debt. So, depending on, if nothing is mentioned, you should take total. If it is specifically saying long term debt, then you take long term debt, right. And these are other ratios, but This we will see later. Yeah. Next. Opinion about ratios may differ. If, let us see this thing, I do not have penny in the short term. She knows that okay, the business is solvent in the long term, but he is unhappy. And if I have unnecessary cash lying in my business of 10 lakh rupees, unnecessary cash, not being used, ऐसे ही पड़े हैं, she will object कि if you are not utilizing your, he will be okay कि ठीक है अपने तो पैसे मिल जाएंगे. Aman will be happy, I am getting my money back, they have lakhs of rupees, I am getting my money back. But she will be unhappy if she is an investor that you have taken this bank loan of 1 lakh rupees unnecessarily. You are not even utilizing it. And if you are not utilizing, you will waste your assets. And then in the long run, you may actually, if you are not being efficient in whatever you do, in the long run you may incur losses, then you will have actually worries over the idle cash also. कि कर क्या रहे हो तुम लोग? Why are you not running your business efficiently? Are you getting that? So she will have issues. Why are you not running your business efficiently? So high current ratio is favorable for a short term creditor, but unfavorable for investor. All of you who had invested the money in the business, they will say, "Bhai, we have not given you 10 lakh rupees of capital, कि ये बैंक में ऐसे ही पड़े रहेंगे." If it was that case, we would have put the money in a fixed deposit and 7 to 8%. Why do I need to take the risk of investing the money in business? When I invest the money in business, you remember that higher risk and higher return, that Pushpa clip we had played, right? So if I invest money, if I take high risk, I expect a high return. अगर 7% ही चाहिए था तो मैं अपने आप, I would have slept peacefully at least. These days I can't sleep. What are you doing with my money? Right? You have taken 10 lakhs rupees, not utilizing it efficiently, and I could have put it in a fixed deposit and slept peacefully कि चलो सब safe है, right? No risk. Next. हाँ एक मिनट, go up. One more thing. ये ना, हाँ अरे कहाँ जा रहे हो? हाँ, unfavorable may indicate excessive levels of inventory and receivable also. At times, too much of monies may be stuck either in receivables. So Chirag has not given me my monies. क्यों ऐसे काम मत करो? You can keep begging कि भाई जल्दी दो. If the person is unethical, you know in real life, very often you might have seen people say कि यार payment collection के लिए जा रहे हैं. You might have seen it, ना? Because giving money is easy, getting it back is a headache. You have heard it, na? Anyways, you have friends. You paid for your friend last time. Did you get your money back? Right? So investors are and creditors. Next time I go to her for loan, she said, "What? First you tell me what is it your current business plan? Why do you need the loan? And what have you done with the previous loan? And why do you need a fresh loan? How do you propose to pay it back? How will you pay my interest?" These are the kind of questions she will always ask me, right? So either, and if you are all the shareholders in my company, in the annual general meeting, will you not bombard me with the management with the questions? कर क्या रहे हो हमारे पैसे का बताओ? Give us an explanation, right? You remember we had played on day 2. Don was not Don, SRK was asking, right? What did he say? हिसाब दे, पैसा कहाँ गया? Investors will say ना, पैसा गया कहाँ? हिसाब दे, right? So it changes suggest this ignore. Decrease in inventory turnover suggest, for example, inventory turnover has fallen, so products have fallen out of favor. Increase in inventory or stockpiling enough inventory. Sales staff no longer doing a good job. You bought lots of stuff and all of them are lying here, कोई बिक ही नहीं रहा है. So what can be the potential reasons? एक, the sales people are not doing their job properly. Second, माल outdated हो चुके हैं, nobody buys these products these days, totally out of fashion है, right? Latest fashion वाली चीजें लाओ, they will get sold. Increase and second is of course the increase in inventory. Next. Next. This point is, I didn't make this point. I have already explained solvency. But these are two separate points that I wanted to mention also. Companies can be solvent but not profitable. So, imagine a cash rich construction company with no orders. You have cash but no orders. And alternatively, companies can be profitable but not liquid. Imagine a construction company with lots of orders but no cash to execute those orders. Are you thinking of? So, profitability, so you need both. You need profitability and you need solvency. You need profitability and you need solvency. So, you need both. And I have already explained this. Next. I have actually explained it, but let us quickly go through it. Liquidity is of major concern to short term creditors and management. Sale of inventory and collection of receivables generates liquidity. Assessing excess of work current assets over current liabilities, that is called as working capital, right. So, that at times you also use this term called net working capital. Working capital and net working capital are the same. Working capital means current assets minus current liabilities, net working capital also means the same thing. So, gross working capital is current assets only. Gross working capital is current assets only. This is next. So, let us actually start calculating ratios. So, everyone pen and paper. Yeah, coming back. So, this is our balance sheet. Look at our balance sheet. Current liabilities 250, long term loans 500, total shareholders equity 250, liabilities and capital total, this is total 1000. Financed as current assets 500, net fixed assets 500, total assets 1000, right. So, next. So, what is net working capital? We see net working capital is how much? Current assets 500 minus current liabilities 250. So, 500 minus 250 is 250. Next. Okay. And why have you again stated it? This is long term 500. Acha. Okay. So, here they have said if working capital is net working capital is taken directly as total of assets net, right, then we have 500 minus 250 on this side, which is 250, net fixed assets 500, total 750, financed by long term loans 500 and shareholders equity 250. Are you getting the breakup also? One, if you look at total liabilities, look at total liabilities and capital out of total assets of 1000. On day 1 I said assets of the business, the claim is either by outsiders, in which case it is called liabilities, or by insiders, in which case it is called as equity. That was the essence, right. So, here if you look at it, what is the total liabilities and capital? 1000, or total assets are 1000, which will, and how much is the outsider's share? 750, insider share 250, right. And here we have taken only long term perspective, see, long term, the word is long term. From a long term perspective, net working capital is 250, right. And so, total assets 750 are divided as long term loans 500 and equity 250, and here it is, because this 250 has come on this side and it is reflected as working part of working capital. So, current assets minus current liabilities is reflecting here, rest is the same. But try to see how much of the pie belongs to short term loans, how much of the pie belongs to long term loans, and both are outsiders, and how much of the pie belongs to us as insiders, right. Just observe that. Next. I have already explained, but I will just read it. Current ratio is one of the most widely used balance sheet ratios. It's first thing, it's a balance sheet ratio, not a profit and loss account ratio, because all the components of current assets are coming from the balance sheet. Second is Making a specific conclusion on adequacy of any value of current ratio would depend on several factors such as proportion of various components of current assets, time taken for conversion of these current assets to cash, speed of maturity of current liabilities. So, in this case I am worried because he will pay me after 2 months and I have to pay him after 3 days. What if it is a ulta? He will pay me in 3 days and I have to pay to him after 2 months. No headache. By the time I have to pay him, I will have enough cash. For 2 months I will be sitting on cash. Got it? Na? So, it is the maturity profile of your debtors and maturity profile of your creditors which is also important. My short term creditors I have to pay after 6 months, no headache, 6 mahine time hai. Within that Chirag will pay, Kritiman will pay, others, everyone, Deep will pay, right. So, all of these will pay me and then I have all the time to pay him, no worries, right. So, the maturity profile is equally important. Next, and that is the ratio, current ratio is current assets divided by current liabilities. Yes, next. Yeah. I have already explained. Okay, the other part was you also finance some of the current ratios, not current ratio, but current assets through long term debt, because some of your current assets are always stuck. Some part of your current assets are stuck in debtors, in inventories or other stuffs. So, you may, but it is not necessary to finance it with long term assets. So, I will not go through this. And working capital we have already mentioned is the long term investment in the operating current assets, and current ratio measures the relationship of current assets to current liabilities. Next. Yeah. So, now everyone calculate, chalo, फिर भी you still calculate, everyone still calculate, do not look at this and calculate yourself. How do you calculate the current ratio? Next line में वापस करेंगे, चलो, this you do not have to calculate, it is clear to you, right. Current assets for 2006 was 190, for 2007 was 232. Current liabilities increased from 80 to 105. So, net working capital, look at this, earlier it was 110, in 2007 it has gone up to 127, but looks like on an absolute basis if you look, it will look like working capital has gone up from 110 to 127. So, it looks good, but on a relative basis if you see, increase in current asset is not proportional to the increase in current liabilities, and margin of safety increased by 17 million. This is true, margin of safety has gone up, but the current ratio has gone down from 2.38 in 2006 to 2.21 in 2007. Are you seeing that? So, both absolute and relative numbers must be considered jointly before any decision is taken. Any one number may be misleading. This will give the ratio. If nothing, you do not look at this and you look at only this, you will think, array, whether there is some trouble, because if the trend continues for a few more years, we will very soon be in trouble, right. But if you look at this, it will not, it is not an alarming situation, let us be honest, because overall the net working capital has also gone up, but the current liabilities has gone up from 80 to 105, more than 30% increase. Do you see that? 104 would be 30% increase, but current assets have only increased by 42, which is just 22 and 22%. Are you seeing that? Yeah, next. So, current ratio has decreased. Yeah, quick ratio. See, in an exam the question can be for anything. It can be quick ratio, it can be acid test ratio, it can be liquid ratio, all three mean the same thing. All three mean the same thing. So, quick ratio or acid test ratio or liquid ratio is usually computed by taking current assets which can quickly be converted. That is the reason it is called quick assets, quick ratio, quickly, which can quickly be converted into cash and divide them by the current liabilities. So, as a practical simplification, it is usual practice to subtract inventories and prepaid expenses, not just inventories, but prepaid expenses also, right, because prepaid expense, the reason it is called as practical simplification is prepaid expenses are hardly anything, inventories represent a huge chunk of your business. So, broadly if you are trying to understand what is the situation, then you take out inventory, but ideally you should take out both inventories and prepaid expenses to arrive at the quick assets. And quick assets are the ones that can actually, because the landlord won't pay me my 4,000 rupees back, right. So, if I have to pay him, I have to pay him from cash or marketable securities, right, if he is asking for money in 3 days. And if he is saying 30 days, then some of the debtors who will pay me within 30 days I can also count on. So, quick ratio, let us calculate the quick ratio. Current assets we know 190, out of current assets look at inventories. So, if these were the current assets, inventories are part of current assets. So, when we say current assets, inventory is already included. What are the inventory? 99, 121. So, what are the quick assets? We said broadly we also have to take out prepaid expenses, but not given in this sum. So, then the quick assets are current assets minus inventory, which is 190 minus 99, so that is 91, and 232 minus 121, which is 111. How much are current liabilities? 80 and 105. So, quick assets are sufficient to pay the current liabilities, just sufficient to pay the current liabilities. Are you seeing that? Quick assets are higher than current liabilities and are just sufficient to pay the current liabilities. So, while the ideal current ratio is 2, quick ratio has to be greater than 1 or higher, right. You should have at least that much money that you can pay all the short term creditors. उतना तो जेब में होना चाहिए ना, otherwise you are technically insolvent. In the short term, if you do not have enough money, then you are technically insolvent. So, this have you seen this? So, this is clear to everyone. Have you all seen that quick ratio, which is quick assets by current liabilities, has to be minimum above 1, right? And you know how to calculate it. It is very simple, right? I am not asking you to solve it yourself. Next, account receivable turnover is sales upon average accounts receivable. Look at the keyword sales. In business, almost all sales in business, almost all sales for especially for big businesses are credit sales, right. So, account receivable are generated not from sales per se, but only from credit sales. So, the right number to be taken for account receivable is credit sales. The right number to be taken for account receivable is credit sales, but in the absence of information, you can always give a note saying in the absence of information. If information is available, then you can't. If information of credit sales is available, then you must take that number. If information on credit sales is not available, then you can take sales as credit sales and just give a note, assume that all sales are credit sales, and then you can write anything you wish. So, when credit sales figures are not available, we could still compute using net sales that we have seen, assuming that all sales are credit. Time period taken for collection of receivables is of great interest in evaluating working capital, known as average collection period, and comments on what is the interpretation of this ratio. On an average, let us say in our industry we give 60 days credit. Just to help you conceptually understand ki ho kya raha hai, what does this number mean? On an average, in our industry we give 60 days credit, and let us say on an average people pay within 60 days. Some people will pay in 45 to 50 days, some will take 60 to 70 days, but on an average we will get our monies in 60 days. Then account receivable turnover. So, we are collecting account receivable in how many days? 60 days, right? How many days? Account receivable we are collecting, AR collection is 60 days. Then what this ratio is really measuring is called AR turnover. I am just writing AR for short, account receivable turnover. If AR collection is 60 days, then AR turnover is 360 divided by 60 or 6 times. Did you see what is going on? So, which means in a year, in 1 year, let us say I have only one customer. Chirag, I like you by the way. I have only one customer Chirag, और मेरे customer ही नहीं है. So I only sell to him and then he pays to me. So I sell to him on 1st of January. He paid me on 28th of February. 7 दिन बाद he paid to me. Again I sold to him on 1st of March. He paid to me on 30th of April. Again I sold to him on 1st of May. He paid to me on 30th of June. Again I sold to him on 1st of July. He paid to me on 31st August. I sold to him again on 1st of September. He paid back to me on 31st of October, and I again sold to him on 1st of November, and he paid back to me on 31st of December. So, are you seeing what is going on? So, this is what I am trying to say. AR collection is 60 days and AR turnover, just to help you conceptually understand what does it mean. So, AR turnover is 6 times. So, 6 times in a year my account receivable is turning, right, just to help you conceptually understand what is going on. Otherwise, लोगों के conceptual level में they do not understand what is going on. Are we clear at conceptual level? So, AR collection is 60 days and AR turnover is 6 times, and that is the what this is what this ratio is measuring. If you just think of one customer, then you understand it better, and that is exactly what this ratio is measuring, that my AR turnover is 6 times and AR collection is 60 days. And when you talk of hundreds of customers and hundreds of collection times, then it becomes a khichdi. But when you the moment you see AR collection 60 days, you just interpret, okay, broadly in this industry collection period is 60 days, AR turnover 6 times. So, effectively the account receivable is getting turned over in a year. If it is 60 days, then it will get turned over 360 divided by 60, or 6 times in a year. Are you all clear? That is what this ratio is measuring. Next. Yeah, the thing that you have to consider is, for accounts receivable or inventory turnover, you have to consider average. So, average account receivable, for example, so if it is a case of month, at the beginning of the month and at the end of the month. If it is a case of a quarter, beginning of quarter and end of quarter, if you are measuring ratios. If you are measuring ratio for one full year, then it is beginning of the year and end of the year, right. So, if average is available, then you must take average. If average figures are available, then you must take average. But if average figures are not available, then you can say assumed that closing balance is, opening balance is same as closing balance, assumed that, and therefore, that is closing balance is therefore also the average. So, sales in our case is 280 versus 300 for the 2 years, sales per day 280 divided by 365, 0.77, 380, 300 by 365, 0.82. Average accounts receivable is given as 20 and 32. Accounts receivable turnover, if average accounts receivable is 20 and sales, assuming it is credit sales, right. If cash sale is not given, then you will assume it as credit sale. So, 280 and 20, sales by average accounts receivable. So, this is the accounts receivable turnover, 280 by 20, here it is 300 by 32, so 9.37. You can see that. Average collection period, if account receivable turnover is given, then average collection, if either of these numbers are known to you, you can compute the other one. If you know AR, इसमें क्या मिला था, AR turnover is given. So, if the AR turnover is 6 times, then you can say that the account receivable collection period is 60 days, 360 by 6, right. If X is, if some information is known, you can use it to compute the other information, right. You need either or, you do not need both. If AR collection is 60 days, you can say AR turnover is 6 times. Alternatively, if they say AR turnover is 6 times, then you can say if AR turnover is 6 times, that means AR collection period is 60 days on an average, on an average. So, that is what is going on here. AR turnover is already calculated. So, average collection period is what, 365 divided by 14, 26 times, and here it is 365 divided by 9.37, which is 38.9 times. And what is the average collection period using accounts, average accounts receivable during the period? So, the average collection period can be something in between, and average accounts receivable turnover is again mix of the two, right. Next. So across years, chale jao. So we have understood that. So year wise calculated, and don't worry about the last two averages. You just calculate it year wise based on the information provided. Inventory turnover. The same with inventory. Let us say I am in a business where I buy something today, एक दिन आता है आने में, next day I am buying, say let us say selling fish. So I keep it in the water for half a day and I brought it in the evening. So next day morning I am selling the fish kilo ho gaya. So fish will die. So let us say I don't have enough water storage. So next day it will die, right? So if I am in the business of selling fish or perishable products, so I buy today and sell tomorrow. So every day I am selling, right? So inventory turnover for such a case, if I am selling every day, my inventory turnover using the same concept as AR turnover is, if I am selling every day, 365, because I am selling within one day. Or let us say I buy a milk in the morning, I sell in the by evening I have sold everything, because I know tomorrow it will get spoilt, right. So if I am selling within one day, my inventory turnover is ratio is how much? 365. 365 divided by, अगर 360 बोल दो तो 360 कर दो, 365 divided by 1 is 365. Alternative, are you getting what I am saying? It is the same concept, but conceptual application of the same concept, right. So how do we measure the inventory turnover ratio? Inventory turnover ratio is, for what are the information that you need first? You need first of all, you need cost of goods sold. So cost of goods sold is 140 and 148, per day ko bhul jao. So how much is our inventory? 99 and 121. Inventory turnover is how much? If inventory is cost of goods sold upon average inventory. This is cost of goods sold, this is inventory, and this is cost of goods sold upon average inventory. So inventory turnover is how much? 140 by 99. एक बार ठीक है, and in here it will be inventory turnover is 140 divided by 99, which is 1.41, and inventory holding period, if inventory turnover is 1.4, means you are holding the in a 1 year the inventory turns over only 1.4 times. If I was selling daily, my inventory will turn over 365 times in a year. I brought in the morning, I sold by evening. So my inventory is turning over 365 times in a year. Every day I buy milk in the morning and I sell either in the morning, afternoon or evening, topic closed. Again next morning I buy fresh milk and I sell it. So my inventory of milk is turning over daily, which is it is turning over 365 times in 1 year. My inventory of milk is turning over daily, which is it is turning over 365 times in 1 year. So that is inventory turnover. But if my inventory turnover is only 1.4, not 365. So if it is 365, it means daily sale ho raha hai. But if it is only 1.4, means in 1 year I was actually holding the inventory for almost 250 to 260 days. 1.4 means I was holding the inventory for 250 or 260 days, so it is 1.41, right. So and inventory holding period we have already seen is 260 days. So if the inventory turnover is 1.41, holding period is 365 divided by 1.41, which is 259, right. So and inventory holding period based on average inventory, if we take the average, then it will come to 270 days. Yeah, इनका average कर लेना, then it will come to 270 days. Next, yeah, the inventory holding period we can see is actually quite long, 260, 270 days, that is a hell lot of time. Yeah, so 270 days is 9 months, so you are holding the inventory for 9 months, that is a lot of time, right. You should sell it faster. If you sell faster, so that is the reason these are also measuring the efficiency of the business. Why? इतना अगर माल लाके रख लोगे शॉप में, if you are not selling it, how will you make profits? Same product, if you buy and sell continuously, are you getting it? Next. So अब इनको, so this is the key point. Excess inventory represents wasteful use of resources. You bought a shoe 9 months back, it is still lying there, and now today you are selling it. Instead, and on that shoe you earned say 5% profit. So instead, if you are selling shoes not in 9 months but after 1 month, 1 month आया, shoe बेच के निकल गए. Again, fresh set of pairs came, you sold it. So in 9 months you have sold it 9 times. So every time you made 5% profit on each of the shoe. And here it was lying here for 9 months, and after that you earned 5%. And that guy, the one who was selling every month, maal aaya, becha, maal aaya, becha. Are you getting what I am saying? So in excess inventory represents wasteful use of resources. The rest you can read on your own. Yeah, next. I am just, because I have already explained, इसको ignore कर दे दो, account payable turnover ignore कर दो. So I am stopping this part, but I'll just take go directly to slide number 59. हाँ, अब 60 पर आ जाओ. Come to 60, yeah. So let's talk about basics of profitability ratios. So the long-term survival depends on the ability to earn sufficient surpluses and to grow. Only if the operations are profitable, the company will survive in the long run. Marginal sales. Profits are generated by sales. Profits are generated by sales. So you will measure the margin on sales and you measure it for multiple ratios. We said, na, do you remember? We had, when we prepared the, we had sales minus cost of goods sold, which is, I am writing gross profit. Then we had minus all the operating expenses other than depreciation, right? So then we had EBITDA. Now minus depreciation, we have EBIT. Minus interest, we have PBT, profit before tax. Minus tax, we have PAT or net income. PAT or net income, right? This is what we had discussed. So if you divide GP, gross profit by sales, it's called as gross profit ratio or gross margin. If you divide EBITDA by sales, it's called as, you could call it these are operating margins, right? EBITDA, this is EBITDA by sales and this is EBIT by sales. The only difference is depreciation. That is, these are like, because depreciation, if you remember from one of our earlier discussions, is a non-cash expense. For all other expenses are cash expenses, but depreciation is a non-cash expense. Then minus interest is profit before tax, minus tax is profit. So this is also, PAT is also called as net income. So if you divide this, you get gross profit ratio. If you divide this, you get the net profit ratio. If you divide this EBIT, you get the operating profit ratio, right? Next. Yeah, we are ending within 2 minutes. Sales, let's look at this. 300, cost of goods sold 142, gross profit 152. So how do you calculate the gross profit ratio? 152 divided by 300, 50.67%. Then operating expenses are these. So operating profit is how much? 67. 67 as a percentage of 300 is how much? 67 divided by 300, which is 22.3%. You then go to profit before tax, income tax. So you get, finally you come to profit after tax, which is your net income. So you divide 27 by 300, you get 9%. So that's how you divide and calculate the profitability ratios. Are you all clear on that part? Next. These are last 2 slides, so we are ending very, very soon. Just have that much extra patience. So gross margin or gross profit ratio, surplus available out of sales revenues after subtracting cost of goods sold. It is obtained over the input cost and as such would reflect the efficiency of use of direct inputs given the price, right? Next. So gross profit is nothing but sales minus cost of goods sold, gross profit margin, gross profit into 100 by sales. Operating margins, we will have that EBIT by sales, right? Next. This is the last slide for the day, and then I'll just wish you good luck for your exams. So profit after tax is also known, AKA is also known as net income. So overall surplus available out of sales to shareholders. This is influenced by 3 major factors: operating efficiency, financing efficiency, and taxation. Which you don't understand financing efficiency as of now. That's fine. As a percentage of sales, it's also called as net profit margin or net profit ratio and is used to compare margins of players in the same industry. एक और वो डालो यहाँ पर फॉर्मूला आएगा एक हिट हाँ. So net profit margin is net profit by sales into 100 and then retained earnings also called as retained profit, amount of profit remaining after distribution of dividend. What was dividend? Amount of profit that is distributed to shareholders, and what is remaining is retained earnings, earnings retained by the business. Hi, this is Dr. P. Sanjay and I am a professor at Indian Institute of Management, IIM in Sirmaur. If you like my videos, please feel free to subscribe to my YouTube channel. Thank you.